This is Brian Kaplan, editor of The Banker magazine, talking to you from the Banker's offices in London. I'm here with Geraldine Lamb, who is the investment banking and capital markets editor. And we're currently working on our special issue for the World Bank IMF meetings in Washington in October. And one of the main themes that we'll be writing about in that issue will be the true costs of bailing out the banks as a result of the financial crisis. Now, there were huge numbers thrown around at the time of the crisis as to how much the bailout cost, but we've always thought that at the Banker that some of this was probably hyperbole and not really the true costs. So what we've been trying to do is to set out and find out what the true costs of the bailout are. And Geraldine Lamb has been working on this story. Geraldine, what was the kind of thinking behind doing this kind of research for the Banker?
Well, what we wanted to try and do is separate the potential costs of government support from the actual capital that was being used. And similarly, we also wanted to try and find out, judging the schemes as they're progressing, what money is actually starting to come back to the government, to kind of separate from fact from fiction, if you like. Because as you say, there were huge numbers, in the trillions of dollars being bandied around. And when you sort of started digging around in government accounts, it was quite easy to see that those figures weren't actually being spent.
I think in the story you say that, the original estimates for the cost of bailing out the US banking sector was something like the cost of NATO and the Vietnam War and the Louisiana Purchase all added up together. But now we're coming through to a much lesser cost. So why is that figure coming down so much from those original estimates?
Well, I think it's a mixture of rather lurid reporting, the rolling up of potential costs with actual costs, the adding of potential costs of the recession, so loss of revenue, perhaps potential costs of quantitative easing, lower unemployment, lower tax receipts, etc. So all of those have been sort of rolled in together to come up with these giant figures. So, for example, in the US, they came up with a figure at one point of $7.5 trillion. Well, in April, Timothy Geithner, the Secretary of State, in an address to Congress, said that he estimates that the cost of the TARP program will be more in the region of about $89 billion. Now, of course, that's still a very significant figure, but it's much less than the $7.5 trillion that was touted in the first instance.
Because one of the contentious areas is clearly the guarantees that were given to bad assets, because journalists tend to sort of add those guarantees up as if they were actually paid out. But in actual fact, you don't actually pay any money on a guarantee until it's used. That's
right. You have to think of them more in terms of an insurance policy. So saying that the UK scheme, for example, which they were providing, I think the limit was about £250 billion. But saying that as a cost to government is like adding up all of the houses that are insured in the UK and saying that the insurance companies owe £4 trillion because that's the value of the properties that they insure. And that's just not the case. So actually in all of the debt guarantee schemes around the government, which have been significant, the total value of the schemes may be in the hundreds of billions of dollars. But in fact, none of the bonds that have been given a government guarantee have yet defaulted, and as far as we can make out, no government has actually set aside capital for those schemes. The same case can be made for the asset protection scheme. So in the UK, only RBS is part of that scheme. They initially put in $280 billion worth of assets. But in fact, that scheme is generating revenue. It's generated $3.9 billion in fees for the government so far, $1.9 billion from RBS, and a $2.5 billion exit fee from Lloyds, and has not cost them anything. And equally, both banks were charged a total of $70 million for the development costs.
Well, I was going to say that. I mean, there was an awful lot of ways in which fees were charged to the banks for underwriting fees or, high loan fees, higher than market rates. So a lot of fees that were charged, which was money flowing back to the government. Is that correct?
It is correct. And in fact, a huge amount of money is coming back to the government. In the US, it's sort of difficult sometimes to separate out the various different costs and the money is coming back.
Because it's so complicated.
Because it's so complicated. So there's been sort of preference share conversions. Sometimes the governments have charged underwriting fees. and there is some have received dividends, some haven't. So it's quite difficult to kind of separate out all these, tease out all the various figures. But in the US, 76 banks have now totally repaid the money they received through the US TARP scheme. And the average return on investment for that, including fees and dividends, is about 10.2%. Some individual banks have generated a non-annualized return on investment of more than 20%.
And so looking at the various schemes in different countries, I mean, which one do you think has managed it the best, and which one is likely to show the best return? Well,
it's very, very difficult to compare schemes. You're not comparing like with like. Equally, in terms of scale, you're not comparing similar programs. So, for example, it's very difficult to compare the French scheme with either the UK or the US schemes, because the latter two are on such a larger scale because of the relative size of their financial systems to the economy. But the French government is actually already declaring a profit on its intervention. UBS, when the Swiss government intervened in UBS and injected capital into that, they made a profit when they exited their equity investment. So it is very, very difficult to judge the schemes. Equally, in some countries, such as Germany, which had a very complex and rather opaque banking system made up of a handful of privately held banks and then regional state-owned Landesbanks and Sparkassen, the response has been equally complex and opaque, with lots of cross-holding, lots of cross-investment, and it's very difficult to judge what the break-even point will be on that scheme, because we actually don't really know the cost of capital that was put into those banks. So it's very difficult actually to compare it.
All right, but in the UK things are a bit more transparent, and we're seeing a situation here where the banks in which the government has a major stake, which is obviously Lloyds and Royal Bank of Scotland, with the recovery of the equity markets and the fact that the banks are now starting to show profits, it seems as if the government could actually realise some profits on those equity stakes. Given that and the other things that we've mentioned, I mean, do you think that the UK government will not only just not make a huge loss, but could actually make a profit out of the bailout in the longer run?
Well, certainly there are certain economic analysis groups in the UK who are suggesting that we'll make a profit. One has suggested the UK government might make a £19 billion profit. The chief executive of the Asset Protection Agency, which runs the asset protection scheme in which RBS assets are held, has already stated that it will probably make a £5 billion profit. And certainly the scheme has been structured in such a way that RBS has to absorb 60 billion worth of losses before anything hits the taxpayer. So certainly it seems that it might do. And if on paper, it certainly looks as if we are already sitting on a paper profit. When you include all the fees, premia, underwriting fees, etc., and you work out the average cost per investment for RBS and Lloyds, including those fees, we have now brought that investment cost down by several pence. So we're already sitting on a paper profit.
OK, thank you very much, Geraldine. Well, this is obviously going to be very good news for governments, both in Europe and in the States, when they're facing very serious budget deficits, and there's a pressure on them to balance the books. And it's a story we're going to be following over the months ahead, but this first report that we've been discussing today, written by Geraldine Lamb, Investment Banking and Capital Markets Editor of The Banker, will be in the September issue, which will be at the IMF World Bank meetings in Washington in October.